Hello, everyone. Welcome to our virtual client update webinar. With the move to our breakfast, with the move from our usual in-person format, we're just so pleased that so many of you have been able to make the transition with us, and we see some new additions to the group as well. So thank you to everyone for being with us here today. Those of you who have been with us for our in-person sessions before know that we like to focus these updates on a few key of-the-moment compensation issues that we think committees are facing today. And so, as it might be no surprise, we're here this morning to discuss the impact of COVID-19 on executive comp and go through some of the issues that committee members should really be prepared to engage with over the coming months. For our purposes today, we've divided that rather broad subject matter discussion into 4 key pillars to help organize our thoughts a little bit. First, we'll be hearing from Matt Cito, Senior Consultant with Meridian. He'll be taking us through a high-level update on the pay actions that we've seen in the market already and which industries in particular have been the most impacted up to this point. And Christina Medlin, Partner, Lead Consultant, and Head of Meridian's Canadian practice, will be discussing COVID-19 implications for 2020 short-term incentive plans and principles for the application of discretion, which is something we think committee members are necessarily going to become even more familiar with this year. Andrew McElhern, Partner and Lead Consultant, will be taking us through how COVID-19 is impacting in-flight long-term incentive awards, those already granted and subject to the market movement that we're seeing, and some of the strategies that companies are considering to manage those impacts, which includes modification of the terms of outstanding awards, something that's pretty unusual as these things go. And so, of course, that comes with lots of potential accounting and disclosure implications we should be aware of. Finally, Andrew Stansel, Lead Consultant at Meridian, will be rounding out the discussion today by helping us to look forwards towards 2021 and beyond to better understand how COVID is influencing design decisions being made today and the pay structures that we're going to see moving forward. COVID really is a global event that everyone is grappling with at the same time. And so by design, much of what we'll be discussing today is really about principles and trends and ideas that we think are going to be equally relevant for Canadian and US companies in our audience. Now, no doubt there'll be some market-specific considerations when you get down to the details of implementation, but at a high level, the issues that committee members are facing are similar on both sides of the border. Of course, we'll reserve some time at the end for Q&A, and copies of the presentation will be made available to everyone after the session. As one of the benefits of this new platform, please feel free to submit your questions at any time throughout the meeting using Zoom's Q&A feature, which is to say, if you select Q&A from the bottom of your screen, you'll be able to input your question and send it directly to us. We do have a pretty full schedule and a fair bit of content to cover, so without further ado, I'll turn things over to our first speaker, Matt Cito. Matt?
Thanks, Andrew. The COVID-19 pandemic has had far-reaching impacts on the North American economy. Over the next hour or so, my colleagues and I would like to bring you up to speed with our latest thinking on the implications of COVID on executive pay programs, organized across 4 key areas. So just to level set, these 4 key areas are base salaries for fiscal 2020, annual incentives for fiscal 2020, where goals were set pre-pandemic, in-flight long-term incentives, again, where goals were for performance equity were set pre-pandemic. And finally, we'll open up our crystal ball and look to 2021 annual and long-term incentive plan design. My job over the next few minutes is to bring you up to speed with a quick market update, both based on public disclosures and based on our early discussions with clients across North America. Next slide, please. So early on in the pandemic, the initial focus for many companies was evaluating actions, if any, to take on executive salaries. We found that salary cuts were highly dependent on a company's situation and industry, and where liquidity was a real concern, for example, discretionary retail and the airline industry, pay cuts were much more significant. Typically, pay cuts were implemented in connection with employee layoffs and furloughs, or dividend reductions at companies. The shift in focus today has turned from should we cut salaries to when should we restore executive salaries. For companies that announced specific timelines for cuts back in March and April, the answer is easy. But for companies in the majority that did not establish a timeline, there are many considerations a compensation committee should take into account, including the health of the business. So do the same liquidity concerns exist today? How shareholders have fared since the outset of the pandemic? How employees are being treated, and this is a real issue of fairness as well as optics. Potential internal messaging to key executives, and related to that fourth point, executive retention concerns. Next slide, please. One of the most challenging topics on meeting agendas this year will focus on actions being taken for annual incentives. The top graphic on this page reflects data from early conversations with Meridian's North American clients. The dominant approach to date is to wait and see when there's better visibility on the impact of COVID on final year results. But close to half of our clients are already considering or expecting to use some form of discretion. In a few minutes, my colleague Christina will cover some principles committees should consider in the application of discretion. The bottom graphic reflects actions taken by companies publicly disclosing incentive changes so far. And I think we should exercise some caution interpreting these results, given this reflects a small subset of companies that, one, have already made changes to the incentive design program, and two, have taken the view that these changes reflect a material enough event to file an 8K. An 8K being the US filing document required when there's a material change in the business that shareholders should know about. Some actions include the outright suspension of annual incentive plans for the year, lowered payout opportunities for executives, and a complete reset of goals for the second half of the year. Next slide, please. There are a number of reasons to consider adjustments to in-flight LTI awards, but the bar for making adjustments to in-flight LTI plans is much higher. I'll let my colleague Andrew McElhern explain why we think this is, but we can expect the majority of companies not to make any adjustments to outstanding LTI, and this is really borne out in the market data. The bottom graphic again illustrates actions taken so far for LTI that are publicly disclosed, and I'll reiterate the same caution I provided previously on annual incentives. The market data here suggests retention grants are common among filers that issued an 8K. But again, this is based on a small subset of companies that have filed a material update. Ultimately, the decision to grant retention awards or not is highly specific in scope and based on individual company circumstances. There is very little market data so far on the fourth subject, 2021 incentive plan design. So I'll let my colleague Andrew Stansel cover our latest thinking on that subject later in this seminar. And with that, I'll hand it over to Christina to discuss 2020 annual incentives.
Thanks very much, Matt. I think we can move to the first slide. It's certainly going to be very interesting to see how annual incentive plan decisions are made through this proxy season. I'm going to talk about 2020 annual incentives and how to manage that. And really the focus on this is going to be on companies that have been impacted by COVID negatively, either severely or to a lesser extent. And what we're seeing right now as we enter into the fall committee meeting season is companies taking one of two paths. A minority of companies have done something that looks like some form of plan reset. While a majority of companies, as Matt mentioned, are in the wait and see category. For companies that are thinking about or have completed a plan reset, probably the most common reset we have seen is what we're calling a first half, second half plan. And this typically applies for companies that have, they're really zeroed out the first half. And so discretionary retail, airlines, organizations like that realize that they are trending to a zero payout, not just in the first 6 months, but that they would trend to a zero payout for the entire year. Now, some of the hardest hit of those organizations have just announced that there will be no bonus payout in 2020. Others have adopted a new set of targets and/or metrics for the second half of the year. The other approach that we have seen a little bit less commonly is to reset goals either for the back half of the year or for the full year, really based on performance to date and what's expected for the balance of the year. Most companies that are doing some form of a plan reset have put in place some form of hurdle or affordability cap. So when metrics are reset, we're not expecting to see metrics reset made easier and a 200% of target payout opportunity maintained. Interestingly, we are still seeing the question of plan reset being discussed even this late in the year. I think that's been primarily because there are a number of companies that haven't had sufficiently good line of sight to date to try and reset targets. From our perspective, the primary reason to reset targets at this point in time, or even a few months ago, was really to help manage employee performance and ensure that employees are fully understand and are driving towards what measures are most critical for the company's performance this year. The further we get into the year, the less relevant that becomes. And we are seeing more and more companies make a decision that they are going to do something on a discretionary basis. So what does it mean to have said we're thinking about discretion? Really, there are sort of 4 key parts to that. The first is that it does not require any change to the plan measures or the plan targets. The second is that, and we think this is best practice, and it's certainly practice that's been adopted by a number of our clients, that companies are establishing in advance principles to be used to help inform or guide that discretion. Third, the committee is likely this time of the year or even earlier, the committee will have said to management, we commit to consider the exercise of discretion. We haven't yet seen companies say, for sure, we will exercise discretion and we will exercise it to increase compensation. One of the things that companies are really concerned about at this point is making sure that any actions that they take are reasonable, taking into account the year's performance holistically. So typically it involves communication by the committee that the committee will consider the exercise of discretion. And then the last piece of the puzzle is that accruals under the financial statements really need to be based on anticipated exercise of discretion. That process is not scientific in any way. We are not seeing financial statement accruals based on what the anticipated discretion is going to be down to any sort of fine number. But what we're seeing is CFOs in consultation with the committee choosing at sort of an arbitrary accrual, whether it's 25% of target, 50% of target, or 75% of target. And one of the reasons that I think we may still hear discussion about plan reset is that some companies seem to think that ISS and Glass Lewis will look more favorably on a plan reset than they will on a pure exercise of discretion. At this point in the year, we don't think that the proxy advisors are going to look differently at those 2 alternatives. What it's really going to come down to is that the exercise of discretion or the plan reset leads to a reasonable outcome in terms of payout level, and that there is very strong disclosure supporting that. The best disclosure, we think, is going to be supported by principles which guide that discretion. Next slide, please. So we think that where discretion is tended or expected to be used to override formulaic annual incentive outcomes. That discretion really should be based on principles. We've set out a number of the principles here, and I wanted to talk through a couple of them in detail. In that first red box, performance against goals, we think that most committees will take a look at what actual end-of-year performance was against the goals at the start of the period. The nuance then is that committees will want to get the best sense that they can of how COVID impacted the results. So basically, what would the year have looked like without the impact of COVID? Shareholder experience is going to be really critical to not so much whether discretion is exercised, but where in the range that discretion ends up. So a company whose share price dipped at COVID and then has come back up to generally the same level, we expect to see committees more receptive to exercising discretion at the higher end of that range. And where share price is down and has stayed low, we're expecting that will be a relevant factor on payouts sort of lower in the range. Performance relative to peers that have been subject to similar macroeconomic influences, whether or not it's the formal PSU peer group, performance relative to peers is going to have a similar impact, not on whether there is a payout, but on determining where in the range that payout is. There are other things, though, that the committee can consider to help support the exercise of discretion. And one of them is strategic achievements and accomplishments to date, which help the company be set up either to come out of COVID or set up for longer term success. We think most companies are going to consider most committees will consider how the company responded to the COVID crisis in terms of keeping employees and customers safe. And some of those heroic efforts are going to have a significant impact on how a committee views the annual incentive payout. Of course, affordability is a factor. And we also expect to see one of two approaches on individual performance. Some companies will take the view that everyone was in this together and make minimal differentiation based on individual performance. Other companies will use individual performance as the toggle to provide greater rewards to those who worked exceptionally hard. Probably, though, the single most important factor this year is going to be stakeholder, employee, and community perspectives. And we think that there is going to be a fair bit of emphasis on and consideration of how the community in which the company operates is likely to view a decision to make a discretionary increase in the payout. On another note, symmetry does matter in this context. There are all kinds of negative impacts of COVID on a significant number of businesses, including increased supply chain and labor costs, additional operating costs. But for some companies, there actually are in some cases, material benefits. There are cost savings that have been achieved, saving of business and travel expenses, may even be lower turnover, higher safety because you have a more limited workforce and you're dealing with your more experienced, more senior employees who tend to be safer operators. And it may even be that for some companies, COVID has actually accelerated a movement to more online, which may actually be more profitable business. So it's not going to be mathematical, but it will be important, particularly in your disclosure, to make it clear that you've considered both the puts and the takes. Disclosure, as I mentioned, is going to be critical to getting investor and proxy advisor support. But it's not just disclosure. It is going to be important what the outcomes are, and the level of payout is going to matter. Next slide, please. In order to help address the outcome, companies are considering what we call guardrails. Simple things like the payout is not going to be higher than target, and others will look at more complex profitability or percentage of profit pools. Normally, we would expect that there would be a greater appetite to exercise discretion below the level of named executive officers, but that is not the discussion that we've been hearing in the committee rooms so far. In fact, there seems to be a general recognition that the circumstances are so extraordinary and executive teams are doing such phenomenal work that executives should be included in any exercise of discretion. Probably most importantly, the exercise of discretion is not going to be fully principled or fully formulaic. So it's not going to be, in most cases, what did our performance look like, back out on a mathematical basis the impact of COVID, and then drive a payout factor based on that. This may not feel particularly fair to the management team, who will have worked incredibly hard and had something completely extrinsic to the business have a significant impact. But some of those other principles and some of those other factors we think are significantly important enough that there's going to be a true exercise of judgment in assessing the payout. Based on our discussions to date with investors, and also what we think we're going to hear from the proxy advisors, we think that there will be an acceptable range of payouts, which is getting people into the payout range, but not for the most part exercising discretion to provide payouts that are above or significantly above target. In terms of the signaling from the proxy advisors, we think they are being cautious. Next slide, please. The proxy advisors have not made formal changes to their policies, although they have done some signaling. And the signaling to date has been that the proxy advisors, both ISS and Glass Lewis, are likely to be receptive either to changes in annual incentive plan targets or to the exercise of discretion, but both have signaled that they will take a different view with respect to long-term incentive plan changes. Although what the proxy advisors think has an influence, we really think that this year, the other factors, how the media is going to look at this, community, employee, and stakeholder perspectives are really going to trump proxy advisor response. Just for interest, Glass Lewis, in their usual gracious way, have said that executives should understand that they may not be worth as much as they were before COVID. And we do have one early out ISS recommendation. ISS has recommended against say on pay at Nike based on, among other things, the exercise of discretion to drive 100% payout under the annual plan. But we think that there were so many other factors going on in Nike, including exercise of discretion under the long-term plan and some guaranteed compensation for the new CEO, that we don't think that this is an early indicator that ISS is going to view any exercise of annual incentive plan discretion in a harsh light. Nike was, we think, outside the fairway on a bunch of issues, and it's these outside the fairway issues that compensation committees really struggle with. Next slide, please. These are really what I've called the issues with an added degree of difficulty. The first, and I think we've discussed this a little bit, is a request that the committee exercise discretion to increase a below target payout to above target, or even more difficult, and already above target payout to something significantly higher above target. We think that adjustments need to be symmetrical, and that unwillingness to consider some of the benefits of COVID can add difficulty both to the disclosure and to the outcome. The primary issue, I think, is going to be payouts that are really tone deaf to the community or to stakeholder experience. And then there's a special class of companies that we think are going to particularly struggle this year, and these are non-calendar year-end companies. The one reason we think they're going to particularly struggle is that we are not likely to be in a position where it's smooth sailing, everybody sees a clear path forward, and the economy is in full recovery mode. But the other issue is really a little bit more to do with just being first out of the gate, the first disclosures of the exercise of discretion. And because there are fewer companies that don't have a calendar year end, we think that there will be a disproportionate amount of both media attention and proxy advisor focus on those companies. So when we start to talk about additional degree of difficulty, long-term incentives come up. And I'm going to turn this over to my partner, Andrew McElhern, who is going to talk us through and give us all of the right answers for how to manage adjustments to in-flight long-term incentives.
All of the right answers. Hopefully I can measure up. Thanks, Chris. Good morning, everybody. Let's go to the next slide right away. Thank you. Yeah, so the first question that was posed earlier is, why is the bar higher for long-term incentive compensation during a time of COVID? Why is the bar for adjustment higher? The comments that follow are based in part on things we have seen happen and in part on things we think will happen yet. This is certainly a hot topic, what to do with in-flight long-term incentives already granted before COVID hit. What should we do? Part of the reason why the bar is higher generally is that one of the norms in executive pay is that there's the long-term category is there for alignment with the shareholders as much as or more than it is there to motivate particular behaviors. And keeping that alignment with the shareholders means not making particular adjustments because something bad happened in the economy, because shareholders don't get the benefit of some escape hatch on that. The particular fact pattern with respect to COVID that also complicates this discussion is shown on the chart here, where two things are true. For many companies, certainly most with a calendar fiscal year end, they granted their long-term incentives for 2020 before COVID happened. If we advanced the schedule on COVID about 6 weeks into the February or January timeframe, we would have been having different conversations about what to do with this, really, as companies got ready to grant their equity, and they might have made adjustments. The other thing that has happened, as shown by the two lines, is that in general, the stock market has recovered since the initial dip in April. I don't quite want to overstate this because the composite lines that you see there for the S&P 500 and then TSX composite are market cap weighted, and therefore they have a heavy weighting to companies and industries that have been more or less pandemic proof, particularly in the technology sector. But as a general statement, the stock market has recovered, and therefore the rationale for making sweeping adjustments in long-term incentives, some of that rationale simply drained away with the passage of time and what has happened in the market since then. Can we go to the next slide, please? So there's, as I noted, there's a fairly strong governance norm that was there before, but has only strengthened in recent years about not immunizing employees who receive long-term equity-based compensation from the same impacts that regular ordinary shareholders have. And that's why, for example, on the left side, under time-vested long-term incentives, it would be fairly audacious in the current environment for a company to engage in a stock option repricing or exchange. The last time we saw any significant activity along those lines was really a little more than 10 years ago, after the financial crisis, when we did see some activity. But even then, the reaction from third parties to stock option exchanges was fairly significant in some cases. Similarly, where because of the increase in the share prices during the course of the year, I don't think we are going to see any programs of widespread make-whole awards on lost equity value, simply because in many cases not that much value has been lost for time-vested long-term incentives. I refer here to stock options and time-vested full share units, restricted share units, or RSUs as they're called. We are, however, seeing the conversation about retention awards for key individuals or key categories of individuals. And what's a little unusual in this case is those retention award discussions are taking place in a context, in some cases, of pretty aggressive recruitment to get top talent out of a given industry and go to other industries that's more pandemic proof. I'll talk more about that in a moment. But really, when we think about where might decision makers make decisions with respect to long-term incentive compensation, it's really the performance vested equity, PSUs, performance share units. And in particular, most of the focus thus far has been on the cycle that started in 2018, if you have a conventional PSU design, and ends at the end of this fiscal year. Most compensation committees, we have found, prefer to make decisions while they have as many facts in hand as possible and not speculate. And there's an underlying norm there that if you make an adjustment to an outstanding long-term award, you can probably only make it once. I mean, technically, of course, you could make multiple adjustments if you wanted to, but those come with a cost. And so practically speaking, it's only going to happen once. Therefore, most of the focus has been on what's near term confronting us right now. There are a few companies that are considering actions with respect to the 2019 and 2020 awards, but I'd say relatively few. And the companies that are doing that are ones that have in mind to do something like reset the performance goals associated with those near-term awards. And it certainly makes more sense from that point of view to make an adjustment now rather than waiting until the end of the cycle and then retroactively resetting the goals all the way back to the beginning. Unfortunately, we don't have the option of resetting goals, practically speaking, for a 2018 cycle since it doesn't have much time left in it to run. Can we go to the next page? So I'll talk for a moment about how we see the retention discussion playing out this year, and then we'll talk a bit more about performance share units and adjustments there. This is simultaneously sort of the Goldilocks state of affairs where widespread make-whole awards probably aren't on the table, but neither is a more typical retention program at right, and I'll say more about what that means. It seems to be something in the middle this year, but it's happened simultaneously with a bit of a corporate raider mentality, as I mentioned, where in some sectors there's aggressive recruitment going on, and so companies may feel like they'd like to do more than they probably can with respect to retention. So typically, a retention program is very targeted. It's aimed at a few people. It tends to use low-risk equity-based compensation, so RSUs, and it tends to have long-dated vesting. That may not be how we see retention programs unfold in response to COVID for a couple of reasons. They will not be quite so targeted because in some cases, it's employees beyond just a few key individuals who are being sought after. And some of the enticements that are being offered is still low-risk compensation, but not the same sort of long-dated vesting that you would normally associate with a retention award. Furthermore, in some cases, energy comes to mind. Those recruitment efforts are happening at people who are at companies where the share price may be low right now, and or the cash flow prospects are at best guarded or uncertain for the time being. So the budget or checkbook you have to issue retention awards is probably at a low point, and therefore there are going to be some trade-offs made between all the people we would like to retain versus the ones we just don't feel we can afford to retain. And that tension, I think, will be more prominent this round compared to a classical retention program. In terms of form, in many cases, companies will not actually describe anything they do as a retention award. Rather, it may be framed as if there were cash compensation reductions taken, those reductions will be offset by additional long-term compensation the next annual cycle when that takes place. And in those cases, you wouldn't describe it as a retention award at all. And why attract unnecessary third-party reactions if you don't have to? And depending on each company's facts and circumstances, there may be bolder moves that get taken because you need to use the tools that you have. For example, Some companies might perceive they have a retention need now and they want to address it now. So they'll do that by taking essentially the long-term incentive award that would be made next year and make it now. They'll be setting themselves up for a bit of a disclosure headache, explaining why there was more compensation made this year, and the trade-off will be less compensation made next year, but that is a trade-off that some companies will consider making. You use the tools that you have, not necessarily the tools that you want. Obviously, any special awards, anything that looks like a special award, is more likely to prompt adverse reactions from external observers. So that naturally weighs in the balance anytime we're having the retention discussion. Could we go to the next page? Where I think most of the conversation will take place, really with respect to how we adjust in-flight long-term incentives, is performance share units. So already a narrow slice of the total long-term pie. It's an even narrower slice, really, when you think about where the possible adjustments might take place. Most companies that grant performance shares or PSUs use relative total shareholder return as one metric or the sole metric in the plan. And we really don't perceive either an appetite or really a logical rationale for why you'd make an adjustment to a relative TSR plan. Again, back to that question of alignment with shareholders. There might be some edge cases where a company misses a threshold payout by a point or two, where a compensation committee might decide to intervene, but we expect those to be pretty rare. Similarly, for companies that use strategic measures in their long-term plan, they're already accustomed to evaluating performance, incorporating judgment. I think that will continue. And so there's really no different category of decision-making in that case. It's just a different set of criteria that go into the decision-making process. But where we will see some discussions of adjustments to make because of COVID is performance share units earned based on financial criteria. And that's what we're going to talk a bit more now. Go to the next page. So again, another question of facts and circumstances. It's difficult to say precisely how each company will address financial metric questions when they adjust their long-term incentives, their PSUs. So instead, we set forth some categories of principles that companies will consider. The first is back to the question of compensation velocity. Should we take action? And there will be, starting from the bottom, there will be a pretty strong argument here from a management team's point of view that COVID happened. It impacted our financials in the long-term plan as much as the annual plan. And fairness dictates management teams should not be held accountable for that, and therefore there should be something done to offset that. That will be balanced by that natural skepticism of the higher bar to clear if it's long-term incentive compensation. More external skepticism. The proxy advisors have already said they're going to be more skeptical about adjustments made to long-term incentives. And I think there will be a bit of natural horse trading that takes place where if a company takes action in the annual plan, they will be less likely to take action in the long-term plan. That's just sort of a natural trading off of or balancing that will take place. One important question to confront in the second column there is, what are we trying to solve for? What impact has COVID had? And I think crucially, given the current stock price environment, has the impact from COVID on the performance factor itself been offset by the run-up in the share price? Or to say it a little differently, can you make the double leverage feature of PSUs work in your favor? That doesn't detract from the logical argument that says the performance factor was unfairly impacted by COVID. But when you think about the original grant of a PSU, that grant date value, that's what a compensation committee intends to confer. And if you're still over that value based on the run-up in the share price, notwithstanding the degradation in the performance factor, the case for doing something might be a little weaker than you think. In terms of how these adjustments might get made, it'll be a similar set of conversations as Chris alluded to in an annual plan context. The most probably obvious one of these is to try and estimate what the impact of COVID was on a financial metric in a long-term plan and carve it out. Another alternative that we have over here that we don't have in an annual plan as much is to say, can we change how performance was measured over this 3-year period? The obvious way to do that would be to take the first 2 years pre-COVID as one unit of performance, and then the last year post-COVID as a separate unit of performance, and then somehow average or blend those together, or just strike the third year entirely from the measurement calculation. So you don't completely offer a brute force exercise of discretion, as we see in the next bullet, but you somehow isolate that impact of COVID based on time rather than based on particular quantum to performance calculation. And the last thing you could do, which I think more is a 2019 PSU or 2020 PSU type of action, is actually go back and revise the goals based on a new outlook for COVID. But that brings us into some of the technical watchouts, namely around accounting, if we go to the next slide. So the accounting issue really crept up on us this year because there's just not a lot of precedent for making adjustments due to COVID. And so what sounds like a straightforward process, perhaps not straightforward in terms of whether there's a norm against it, but straightforward in terms of execution, resetting a performance goal or otherwise adjusting the assessment of performance, that has a lot of technical watchouts associated with it, mostly in the accounting realm. So it is important before committing to an action to run through all of the traps noted on this column 4 here. Understand what the PSU award agreement says about permitted adjustments, whether it says anything at all. Be aware, of course, what accounting regime you're working with. In general, it's fair to say IFRS accounting standards seem to be more permissive in this respect than US GAAP. If a company has a pattern of past practice, that could influence how your auditors will treat an adjustment due to COVID. So if you made adjustments in the past, your auditors may say this is the final straw that breaks the camel's back and require that you account for your PSUs differently going forward. And that could have a long-lasting effect. It would not be a one-time expense and then finished. And of course, there's no consensus among auditors, we have found, as to what sort of modifications could trigger an accounting adjustment versus which ones could not. And then lastly, filing a proxy in the United States has potentially more pernicious impacts from an accounting modification to an award than filing a proxy in Canada. So we need to take all of those considerations into account and just understand what's on the other side of that door if you choose to go through it from an adjustment perspective. And then lastly, of course, if the decision makers are going to touch awards that affect a senior team, where there's a proxy disclosure implication, it'd be a good idea to understand what does that narrative look like and to see if we feel like we can defend it. And if a company is making a practice of regular outreach to shareholders, particularly related to say on pay, it would be a good idea to include this topic on that roster of agenda items the next time that outreach is taking place. And with that, I'll look forward to any questions in the Q&A, and I will pass it over to my colleague, Andrew Stansel.
Great, thank you, Andrew. Hello, everyone. Next slide, please. So far today, we've heard a discussion about market reactions and pay actions specific to 2020. Now we're going to turn to our crystal ball and take a look into 21. We anticipate that many companies will make changes to their incentive designs for 21. And for this, we think companies will want to consider utilizing all available tools and strategies in addressing program changes. However, given the challenges created by this pandemic and how it's affected a variety of stakeholders, companies should be mindful of a number of things, including unintended windfalls under awards should stock prices rebound, external optics, shareholder, stakeholder, and proxy advisor firms' views, how companies responded to the crisis earlier, balancing profitability and sustainability, and consider broader workforce and community concerns. Of course, retaining and motivating key talent will be important, but also being forthright in explaining the rationale for any pay and governance decisions for 21. Next slide. So let's start with annual incentives for 21. There are a number of strategies to consider. Some ideas around changing metrics and measurement are listed on this slide. Companies can reevaluate and change metrics to align with new priorities for 21. Revenue volatility driven by external factors makes top line and earnings or income measures challenging versus, for example, costs with which management can control. Select measures that will drive performance and behavior that's aligned with new priorities and goals for 21, and where management has line of sight. Companies can change the performance measurement under the plan. This can be done in a number of ways, which are listed as the next few alternatives on this slide. These include using wider performance ranges around target, adding or putting more emphasis on non-financial measures, or using shorter measurement periods. So let's start with wider performance ranges. Setting wider performance ranges allows you to keep the same core program and metrics while accounting for uncertainty and allowing for payments under more circumstances. But in conjunction with this approach, it's important to assess if it's appropriate to maintain the same payout levels. Companies should consider if the payout entry point should be decreased as well, and if there should be more limited upside in exchange for more accommodating thresholds. You really need to reconsider symmetry around targets. Use probability and risk of attainment to develop payout curves. The payout curve can be asymmetrical. Adding non-financial measures provides for potential payouts despite financial uncertainty. These can focus management on key operational and strategic priorities critical to success going forward. Consider ESG, given the increased focus on these issues pre-COVID-19. However, there is a weaker alignment to financial performance of the company, which may raise affordability concerns. Shorter performance periods provide flexibility to reflect changing circumstances during the year, but these require goal setting, measurement, and increased administration during the year. Finally, Chris spoke earlier about applying discretion in 2020. Also consider exercising discretion on 21 plans. If you're using discretion this year, leverage the experience. If there's no track record of using discretion, now is the time to develop the principles and guardrails and add this feature to your program. Next slide, please. Here's a quick market snapshot on 21 actions based on very limited announced public disclosures, and this is a very small sample of about 24 companies. Early indication is that companies are primarily using shorter periods to manage goal setting. Next slide, please. For long-term incentives, there are several approaches to consider, beginning with vehicle mix, and then moving down to changing metrics and measurement in performance plans. Just stepping back for a moment, on the left side of your screen is an illustration of what typical long-term incentive program mix looked like pre-COVID-19. As you can see, there's a significant weighting to performance plans. Maintaining this type of mix is likely preferred. Of course, the heavy weighting on performance plans focuses management on longer-term performance objectives aligned with strategy, and it also drives alignment with shareholders. But uncertainty and other factors in this environment may drive a different mix going forward. At many companies, a decision will need to be made about performance plans. Companies that have real difficulty setting goals or have real retention concerns may want to switch out of performance plans to time-based awards for the next year of grants. But those companies will need to be prepared to live with potential negative external reactions, particularly from the proxy advisors. Next slide. Some potential mixes are illustrated on this slide. We do expect many companies will temporarily increase the weighting to time-vested RSUs. These mixes that we've illustrated here are ordered from lower to higher leverage. So starting on the left, the 100% RSU mix, which provides the least amount of leverage, is simple. It increases retention, but one key concern is that it does not meet proxy advisor preference for 50% of long-term incentive to be performance-based. As we move to the right, retaining options and performance plans in the mix improves leverage and alignment with shareholders, but each has its own challenges. PSUs require selection of measures and goal setting, which can be very challenging in the current environment. Options can be viewed as opportunistic in cases where share prices have remained depressed. Next slide, please. Now focusing on performance plans for 21. There are a number of strategies to consider, from status quo to changing metrics and measurement. You'll see some of these strategies on metrics and measurement are similar to approaches I discussed earlier for 21 annual incentives. Retaining the current design works if you have a relative or qualitative strategic measure in the plan and little or no weighting to absolute financial measures. As my colleague Andrew mentioned earlier, there is a reluctance to take action on PSU plans with relative TSR as the sole measure. And so changes may not need to be made to these types of programs. However, there is likely a need to recheck your performance peers for continued appropriateness. Many companies include other measures in their performance plans, such as earnings, returns, cash flows. There may be a need to reevaluate and change metrics to align with new long-term priorities. If you have an absolute financial measure in the plan and can't set targets, consider shifting to relative assessment, as that eases the goal setting burden and auto-corrects for macro level factors. Consider strategic qualitative metrics and ESG measures that are relevant to the new strategy. Consider transitioning to annual performance goals that are established at the beginning of the year rather than a 3-year cumulative goal that is set when the award is granted. This annual approach may be the furthest in advance that targets can be set. Use 1 or 2 year measurement periods within the 3-year plan cycle, with the additional years being simply time vesting to enhance retention. You could consider measurement in only the 2nd or the 3rd year of the performance cycle when the economic climate has cleared and there's a better line of sight. You can set wider performance targets and lower targets, which can allow you to keep the same relevant metrics while allowing for payout under more circumstances. And one additional alternative is to consider is de-risking the performance program, awarding performance cash with earnout linked to performance goals, but not to share price. These types of awards still focus management on performance objectives and provide increased certainty around cash outflows. But the downside is there's a reduced alignment with shareholders. Next slide, please. Here's another quick market snapshot for 21. This one is on LTI actions. Again, based on the very limited announced public disclosures, early indication is changes to vehicle mix will be the prevalent action for 21 LTI programs. Next slide, please. Once the program design is nailed down, there still remains the challenge of sizing awards in the current environment. There are upward and downward pressures to consider, And the trick will be to find an appropriate balance between these two pressures. Retention concerns, value of outstanding awards, prior year performance, and pay cuts may all put upward pressure on award sizes. However, affordability, reserve constraints, which will be impacted by the mix, and low share prices and potential increase in time-based awards may trump any of those increases. So to wrap up this look into 21, while companies can put everything on the table for 21, there will be some key questions to answer, such as what pay for performance, governance, and stakeholder considerations will guide the 21 designs. And whatever is decided, actions will be scrutinized more than usual, so be prepared to provide clear, transparent rationale for any 21 program design changes. Thank you. I'll now turn the session back over to Andrew for Q&A.
Thank you, Andrew, and thank you to all of my colleagues for their contributions to fascinating presentation. There's certainly no shortage of interesting things going on in these unusual times as we navigate some unprecedented waters. I'd like to remind everyone that the Q&A session is certainly still open, and you're welcome to submit questions as we work through the handful that we've got here. As a reminder, the access to that Q&A function may be buried under the More button on your screen, potentially 3 dots. Just a reminder for those of you who may be looking for that functionality and not immediately able to find it. But in the interim, we have a few questions here that I think illuminate some interesting points, and I'm going to ask my colleagues to kind of be available as a panel here. I'll read out the question, and some of these seem a little bit more suited towards one of you and the subject you covered today, but certainly, we all have contributions to make, and feel free to address this as a panel rather than me calling out individuals necessarily. So our first question is one that I think is quite interesting. How will committees balance the tension between rewarding management for their accomplishments in what has been a very challenging, frankly, unprecedented year, and investor or proxy advisor expectations, the other players in the room here? Chris, that seems right up your alley, frankly.
Okay. I think this is probably going to be the single most difficult issue for committees to address. Because you truly do have management teams and employees who are working extraordinarily hard and really doing phenomenal work. And it's going to be very difficult to establish payouts that are really appropriately commensurate with the level of effort that these individuals have been putting in. I think part of the way to think about it and to balance it is really to consider this as a longer term game. Most of your executive team will have, in addition to their annual incentives, long-term incentives. If share price remains depressed, the next award of long-term incentives may actually have the potential to drive significantly more value. And I think you're trying to balance rewarding this year sort of appropriately given what's going on in the community with really saying, okay, this is a long-term commitment, a long-term issue, and over time, executives and management will be appropriately rewarded for the steps that they take now, which position the company strongly for the future and future growth.
Fantastic. Next up, we do have another question, which is, I think Andrew McElhern, likely down your alley primarily, but again, open to everyone. Doesn't it make sense to make the same adjustment to all years of in-flight LTI, particularly now when you likely have the best line of sight on what impact COVID has had on performance? A bit of a counterpoint for us, but what do we think about that? Should we be making all of the adjustments for all of the in-flight LTI cycles at once now that we've got the information, or is it more appropriate to defer decisions on some of those cycles until later?
It could make logical sense to do that now, I guess, for 2 reasons. One is you're comfortable that with what I said previously about you probably only get to do this once. So you're willing to cast your lot now and sort of clear out, it's like taking a big bath in accounting, clear out the decision making, do the reset once, and then get people refocused on the future. So from that point of view, it would make sense. And certainly if you're thinking about your preferred action is to reset the performance goals, if you like, it's sort of a mid-cycle reset for the award that opened last year. It's an early in-cycle reset for the award that started this year. And it's basically an exercise of discretion against the original goals for the cycle that is finishing this year. But that needs to be traded off against, a couple of very practical considerations, probably the most important of which is decision makers generally, and based on what we've seen so far with COVID, are reluctant to make decisions based on speculation. They would rather make decisions based on facts. And so that means probably we see fewer companies resetting performance goals and more companies leaving the original goals in place and then taking action later when there are more facts that you can rely on. And how that argument teeters back and forth is going to depend on whether you think you have a real engagement and retention problem, with the people receiving the long-term incentive awards, and how important it is to, if you like, take 3 potentially broken cycles and restart them and give people proper engagement, proper attention, properties in the LTI. So I don't think it's a straightforward yes or no answer. It depends a bit on which things you're valuing more when you do this balancing.
Well, that makes a lot of sense. We did have we had a housekeeping question about whether a recording will be available for the of the session, and we will be pleased to provide that. Dependent, of course, on our technical prowess successfully securing that recording, but my understanding is that all is in place for that to be made available for us all. We do have another question here. Do you see different approaches to 2020 incentives based on industry? As our what are we seeing in the market right now, Guy? What do you think, Matt? Is that something that we see differentiation from one industry to another in treatment of 2020 incentives, or is it more of a blanket approach?
Absolutely, and we saw that. It's analogous to what was happening with the base salaries. I think the same considerations and principles will be applied to the annual incentives for 2020 plans. So companies that were hit much harder from the pandemic are going to have tougher conversations at the October and November compensation committee meetings about how to make adjustments than those that were not affected as much or even positively affected, like your Amazons and e-commerce companies of the world. So certainly I think there are different considerations for different industries.
Fantastic. That makes a lot of sense. Certainly bespoke solutions for people in different circumstances. I have a question for you, Andrew Stansel. You're our guy with an eye on the future and what's coming. Do you think that the shift that we expect to see in 2020 towards more of that time-vested equity is something that's going to be permanent? Or is that going to stick around beyond, say, the long tail of COVID and be a sticky thing that we look back on as when we took that turn down that path? Or is this going to be a really temporary blip in the radar, so to speak?
Thanks, Andrew. Thank you, Andrew. I don't think that this is going to be a permanent shift in the mix toward time-based long-term incentive equity for 2 reasons. Number one, I think there will be a recovery after COVID-19. Whether the recovery drags on for an extra half year or a year, that's uncertain. But eventually, I think there's going to be a recovery. So companies will regain that line of sight and that ability to set targets and set longer term goals. Depending on how long the recovery is, we could see a shift in time-based awards for 1 to 2 years, but I think eventually we're going to get a return to performance-based awards. The other reason I don't think there's going to be a permanent shift is there's an easy out here. There was a lot of push to move away from relative TSR or add other measures into performance plans, but an easy fix is to shift back towards using relative measures in your performance plans. They ease the goal setting burden and take into it and level set for those macro level factors. So again, I don't think this is going to be permanent.
Okay, well, that'll be interesting to, well, we'll certainly keep an eye on that as things unfold in the future and we have more information at that time, as has quickly become the theme of this year. Speaking of time, we have used up the entirety of our allotted time, and we want to thank everyone for your time and joining us today. Part of your busy schedule, we know. Just a reminder that we'll be circulating a copy of the materials presented as well as a link to the recording for those interested. And we are here and available to help you navigate these specific questions and figure out how to implement these strategies in your own circumstances. So thank you again for your time and enjoy the rest of your day.
Thank you all very much. Bye-bye.
Thanks.